All right, welcome back to Rain King Insights. In today's GMU Extra, we're going to look at an important concept, which is called selling on technicals. Again, the presentation is for educational purposes. So we're going to go over this important concept, why we sell on the technicals, not the fundamentals. We have to remember that the market is a discounting mechanism, and it's looking 6 to 9 months ahead. And so we're always looking at the charts to tell us when a stock should be sold after big gains. Now, many times it can be very, very confusing to retail investors about why we're selling a stock that seems to be performing well and has great earnings and sales. Well, a stock's action around earnings report, as we know, can be very confusing in the sense that sometimes stocks go up on very poor earnings reports and they go down on apparently good earnings reports. And that's because the institutions are always looking ahead. So an institution that has a large position will need to gradually sell its position over many months to get out of their position. And consequently, when they're buying a position, it takes months. So they can't act on a one-day affair. So we want to look at this very, very objectively when we do our charts and look at our chart reading skills. Now, many investors got caught in the 2021 topping process for some of the biggest winners from the COVID bull market, and they took really unnecessary, huge drawdowns. Look at these big winners and some of the peak to decline. It looks really unbelievable. Square off 85%. Peloton, a staggering 97% decline. These are devastating if you hold on to a stock too long. So let's look at the basics, the life cycle of a growth stocks. We trade growth stocks. And so typically when a market corrects or a market bottoms during a bear market, stocks will form bases. Once those bases work out themselves, there's usually a catalyst to create a breakout, whether it be an earnings surprise or news about the company. Once you get a stock kind of in motion, it starts its uptrend. And the uptrend usually has a number of things on the positive side on the way up. We have positive earnings surprises where the company is beating the street. And then finally, the analysts move their earnings estimates higher, creating more momentum for the stock. And then a couple quarters go by and the company meets or exceeds expectations with this earnings per share momentum. Eventually, the market tops out and growth stocks top out. And then on the backside of this, the stock starts to lose earnings momentum and starts to guide the street lower in terms of earnings and sales. Eventually, there could be a negative earnings surprise on the way down, and earnings estimates gradually get moved lower. Now, Nicholas Darvas in 1959 probably said it best, quote, "The biggest factor in stock prices is the lure of future earnings. The dream of the future is what excites people, not the reality." It's this earnings momentum and the narrative around the stock that really drives the uptrend with institutions accumulating the stock. So let's look at some examples of this and why we use the charts to sell a stock even before the fundamentals deteriorate. Here's Shopify, a really, really big winning stock from 2018 all the way up to the top in 2021. I've marked here, look at the earnings report, plus 999%. 467%. Incredible earnings momentum on the way up. Eventually, you can see here as the stock starts to peak, we still get a good earnings report. The earnings are up 109%. You can see here I've drawn a line around this June 2021 earnings report. Sales were still very strong and the earnings were triple digits. You would say to yourself, there's no reason to sell the stock. But there were sell signals climbing up on the chart all over the place. You can see here that Shopify tried to form a breakout here, but it failed. And it's because the stock was starting to get tired. It had made a long multi-year run and the breakout didn't stick. Then the stock tried to form another base, a kind of a wide and loose late stage cup base. That stock tried to break out. And you can see here, even though we had plus 900% earnings report, the stock didn't go anywhere and eventually was another breakout failure, the second one. Another earnings report, triple digit numbers. You can see here the stock actually tops out just after that earnings report and we get a third failed breakout. clear signs that the stock is in trouble and probably should be sold or at least reduced. And you can see here on the backside, you can see all of a sudden the next few earnings reports are good sales, but the earnings are down 27%. You can see earnings down again and eventually down in a material way. So this is the backside we want to miss, but you have to find the sell signals up front so you don't get caught holding a stock. Now, all of this is really counter to how a rational person thinks. Most leading stocks top out, believe it or not, when the fundamentals look great. And you can see they did look great for Shopify. But if you don't trust the technicals, you could give back a huge amount of your gains, and it can be quite painful. Here's another one. Here's Netflix, a big winner after the 2009 market bottom. You can see incredible move by Netflix. On the way up, earnings per share were going up 35%, 55%, 85%. But you can see here, long in the run, we form a fourth stage base, and the stock fails. Stock fails, it's giving you a clue the stock is tired. Eventually, when we're looking at a weekly chart here, we get a very serious major sell signal, a 10-week line break. And that is really, really a serious sell signal. Just before that, though, we had another clue. You can see here on the weekly chart, we were making new highs, all-time highs right here, and the stock had hardly any volume on the upside, showing you that buyers were just exhausted. There were no buyers left. They had already been in the stock. So again, another example of looks good on the way up. Now, eventually, right at that peak is when Netflix reported 57% earnings per share, and they beat by 14 cents, which sounds great. But the catch was the company guided lower. Now, basically, that's what the street was looking at. And as soon as the street saw that they were guiding lower, meaning the future quarters were going to be worse, that bad earnings and shares are coming in the near future. Institutions started to move out of the stock. And you can see here, 3 months later, the stock still had another good quarter. It actually had earnings per share of 66% and beat the street by 22%, but they guided the street lower again. By that time, you can see the stock is substantially off its highs, and eventually the following quarter earnings per share were down and in the red. So you can see again, great example of a model book stock where the fundamentals look great, but you need to use your chart reading skills to sell the stock. Here's another. Here's Zoom Communications, one of the big winners in the COVID bull market. Tremendous numbers coming out of the COVID demand. Sales up triple digits and earnings up triple digits. 1, 2, 3 quarters. And even right at the top, this earnings report was triple digits, earnings per share almost 1,000%. And you can see the stock was down. That's because the institutions were already seeing a slowing in Zoom's business going forward 6 to 9 months. Now, the stock actually had a very serious 10-week line moving average break, which is another major sell signal. You can't ignore this. And it wasn't until about the next earnings report 3 months later that you saw that the sales were still very good and we had triple-digit earnings. But the street was looking at the forward guidance, and the forecast was only 11% growth in earnings in 2022. That was a very, very bad signal to the street, and the stock started to continue to sell off. By that time, if you've ignored these sell signals, you're giving back plenty of gains. If you look at the monthly chart, Zoom Communications peaked at $588 per share. And as of the recording of this video, it had come all the way back down to $60 per share. What an incredible decline. So the biggest of winners need to be sold when the chart tells you it's time to be sold. Now let's look at something more recently. Here's Nvidia, probably the market leader, one of the most incredible stocks for 2023 and 2024. This is the actual slide that I used in my general market update on June 21st, 2024. And I was pointing out that even though Nvidia was an incredible stock making incredible gains, you didn't want to be blind and bullish. You needed to keep your chart reading skills at the forefront. And I pointed out a couple of sell signals as they were happening in real time. Here's the weekly chart. You can see here that we had an upper channel line break. That's an offensive sell signal. So that's one clue that maybe things are changing. Also, psychological price level. We had the 3 trillion valuation, which was $123 a share. That also can be troublesome for a stock reaching such a valuation. And we had a 10-for-1 split. I pointed out that was an incredibly large split. And if you look at the history of stocks topping out, they tend to have very large splits right before or near the top. So we don't want to be blind and bullish, and I was pointing that out. There were also some other daily chart signals that I wanted to show you, and I'm going to go to another chart in just a moment. But I wanted to also point this out. The day that I put out this video, there was a tweet, and I've hidden the name of the person making the tweet. But the point is, this is what they said. There isn't a scenario in the world where Nvidia gets anywhere near 103 ever again. 120 maybe, but I doubt it even gets to 120. I don't know what could be more blind and bullish. This person obviously felt they were bulletproof with Nvidia, probably had a lot of gains. Well, as the recording of this video, this stock has already had a correction, and the current low is $90.69. So this prediction that it will never hit 103 was very faulty. So let's look at some of the sell signals on the daily chart. Okay, so earnings report in May, Nvidia, staggeringly positive earnings report, 262% sales increase, earnings up 455%. Here's the 10-for-1 stock split. And on the daily chart, we see 5 days in a row with very low volume. This is new highs on low volume. That's a sell signal. The split is also a caution sign as well. Then we get this really important key reversal bar. We have a 3-bar break to the downside. The stock tries to make all-time highs, reverses and closes lower, and it takes out the previous 3 bars. And we get a heavy volume cluster, another sign that the stock should be sold or at least lightened up. Then we get this very, very weak rally attempt. We rally to try and get up to old highs. We can't even make it, and the volume is really pathetic. There's no buyers left. The only buyers left are probably retail because the institutions are selling. We get another 3-bar break to the downside, showing more distribution in the stock, and we eventually move through the 50-day moving average. We rally into it. The 50-day becomes resistance, and the stock moves lower. Now, all of this is happening with just an incredible block of numbers for Nvidia. Look at these incredible earnings and sales, triple digits around the board, and even the forecast for the future are very, very strong for one of the largest companies in the world. So this emphasizes again that you can't use the fundamentals. If you wait for the fundamentals to show negative numbers, the stock will be far, far off its all-time high. So that's the point of the video, selling on the technicals. So we've covered a lot. Hopefully I've drilled into your head why we need to trust what we see on the chart. It can be difficult sometimes to sell a stock that you have big gains when you don't see the fundamentals slowing down. But we need to use the chart to guide us and look for sell signals. We need to be very good sellers of stocks in order to preserve our gains. The signals were there in all of those model stocks, and you should study model book stocks. This is a page from my model book stock winners from 2020 to 2021. And this is Fiverr, one of the big winners, up 856% in only 41 weeks. So you should create model book charts. You can look at studying the positive things in this chart. You can also look for sell signals and make sure you note those because they'll happen over and over. Channel line breaks, 10-week moving average breaks, 2 weeks down, 2 weeks up to new highs. These are all sell signals. So you want to study these in improving your chart reading skills. This is a daily chart. And also, that was a weekly chart. Here's the daily chart. And just look at these things in both time frames and really try to burn things into your mind of how winning stocks and how model book stocks act. This model book of winners will be released in the fall of 2024 We're going to do a webinar series on it, and I'll make the model book available for purchase. I believe there's over 80 different model book charts that I've marked up similar to this one. So, important concept, we ignore the fundamentals because they're going to look great at the top. Remember that the market is a discounting mechanism, always looking 6 to 9 months ahead. So if you need some help with education, coaching, and guidance on sell signals inside of our memberships, we have multiple sessions covering sell signals, from basic sell signals at the entry level to intermediate level sell signals. We got what we call a baker's dozen sell signals. And at the Rain King membership, we go over advanced selling signals on the offensive side on the way up. So check us out. We're at rainkinginsights.com. I think we have a lot to offer. And thank you for joining us on this GMU Extra, which was selling on the technicals.